Hi there. Today we unpack how the 2026 income tax freeze quietly pushes basic rate taxpayers into higher tax bills. If you do self-assessment, understanding fiscal drag is essential.
3 million. Just let that number sink in for a moment. That's how many people the Office for Budget Responsibility thinks will be dragged into paying the higher rate of income tax by 2029. And it's all happening because of a government policy that doesn't actually raise tax rates by a single penny. It's a silent, creeping change to your finances. And the real question is, could you be one of them? I mean, with wages having to go up just to keep pace with the cost of living, you could easily be pulled in without even realizing it. This isn't just an issue for the top earners anymore. It's fast becoming a reality for millions of us.
Hello and welcome. Today, we're going to unpack exactly how the 2026 income tax freeze is affecting self-assessment, especially for basic rate taxpayers here in the UK. Now, this entire discussion has been put together for you by the expert tax advisors at ProTax Accountant. They're one of the UK's most trusted accounting firms, and frankly, they're seeing this exact issue affect their clients every single day.
So here's our plan. First, we'll look at the tax freeze itself. Then we'll get into something called fiscal drag. It's the engine driving all of this. After that, we'll see how this is pushing more and more people into self-assessment, check out some real-world case studies to see what it costs you, and finally, we'll talk about how to avoid some really expensive mistakes with HMRC.
Okay, let's kick things off with a policy at the very heart of all this. We're calling it the Great Tax Freeze, a decade of standing still. And you're about to see just how fitting that is, especially when everything else, from your food bill to your mortgage, keeps going up.
What's just wild about this is how long it's going on for. You see, it was announced back in 2021 and was meant to be a temporary thing. But then it got extended and extended again, all the way to April 2031. That means for an entire decade, the goalposts for how much you can earn before you pay tax or before you hit that higher rate haven't moved at all. And these are the two magic numbers right here. Your personal allowance is locked at £12,570, and the point you start paying 40% tax is stuck at £50,270. Normally, these numbers would creep up each year with inflation, to make sure that a pay rise meant to cover your rising bills didn't just get eaten up by tax. But by freezing them, a bigger and bigger slice of your earnings is now getting taxed.
So how does this freeze actually make you pay more tax? Well, that brings us to Section 2. What is fiscal drag? It's a term you'll hear economists throw around, but a lot of people just call it what it feels like, the government's stealth tax.
In simple terms, fiscal drag is what happens when the tax system stands completely still while your earnings, well, they have to move, don't they? As your wages go up, more of your income gets dragged over those frozen tax lines. You end up paying more tax or even getting pulled into a higher tax bracket, all without any politicians actually announcing a tax rate hike. It's a tax rise through doing nothing at all.
I really like this analogy. Picture your earnings on an escalator, slowly going up just to keep pace with everything else. But the ceiling above you, the tax-free limit, isn't moving with you. It's fixed. Sooner or later, your head hits that ceiling. A pay rise that you desperately need can push you into a higher tax bracket, leaving you feeling no better off. It's like your wages go up one step, but the tax man takes you 2 steps higher. And here's the result. Look at these numbers. When this was announced back in 2021, the government thought it might raise about £8 billion a year. But then inflation shot up. By 2025, that forecast jumped to over $24 billion. And by the time this freeze is supposed to end, it's expected to be bringing in over £55 billion extra every single year. It's a staggering amount of money.
Now, you might be thinking, okay, fine, so a bit more tax comes out of my payslip. But for millions of us, it's a much bigger deal than that. This brings us to the self-assessment domino effect. People who've only ever paid tax automatically are suddenly finding themselves in a whole new world of paperwork, deadlines, and yes, potential fines.
Now, this is what catches so many people out. The first 2 points here might seem small, but think about it. With side hustles being so common, earning just over £1,000 from a small business or renting something out means you now have to register for self-assessment. But the biggest trap, the one that fiscal drag has really poured fuel on, is that last one. It's all about crossing one very specific line.
Stay with me here. This next point is huge for families. It's called the High Income Child Benefit Charge. The threshold for this has been stuck at £60,000 since 2013. 10 years ago, that was a pretty high income, but after years of wage growth, far more people are now hitting it. The moment your adjusted net income tips over 60K, you have to start paying back your child benefit via a tax return.
So what on earth is this adjusted net income? Let's make this simple. It's not just your salary. You start with all your taxable income, so that's your salary, any bonuses, rental income, that sort of thing. Then you get to subtract any personal pension contributions you've made and any gifted donations. It's a very specific number, and it's the one that HMRC cares about.
And here's a pro tip from our friends at Pro Tax Accountant. They see this constantly. People are looking at their payslip, at their main salary, but HMRC is using this other number, their adjusted net income, to make key decisions. Getting your head around that difference is absolutely crucial. Okay, this can all feel a bit abstract, so let's put some real-world numbers on it. Let's look at a case study to see how this actually hits your wallet, because seeing it in a real-life context just makes it all so much clearer. So meet Maya. She's a freelancer in London. She has a great year, and her income goes up from £49,000 to £51,000. Now, in the old days, that higher rate threshold of £50,270 would have probably gone up too. But because it's frozen, nearly $2,000 of her pay rise is now taxed at 40%, not 20%. Her reward for all that hard work gets seriously dented.
Or how about David? He runs a cafe in Manchester, and he and his wife get child benefit. His wife gets a well-deserved promotion, and her adjusted net income is now £64,000. Boom. Just like that, because she's crossed that 60K line, they have to start paying back their child benefit. It was her pay rise, but now the whole family has a new tax bill and the headache of figuring out a tax return. That's the domino effect, right there.
And that's not all. This next part is really important. What happens if you get pulled into self-assessment and you're just not ready for it? Well, this takes us to our final section, avoiding costly HMRC mistakes. Because right now, the price of getting it wrong has gone up. A lot.
Take a look at this number, 7.75%. As of January 2026, that's the interest rate HMRC charges on any tax you pay late. It's tied to the Bank of England's base rate, so it's much higher than it's been for years. This isn't just a slap on the wrist, it's a serious charge that starts ticking up from day one. You'll definitely want to hear this bit. On top of that high interest, HMRC hits you with penalties. Just 30 days late? That's an immediate 5% penalty on the tax you owe. Still late after 6 months? Another 5%. A full year late? Yep, another 5%. They all stack up, turning a manageable bill into a real financial headache very, very quickly.
So here's one last pro tip from the team at Pro Tax Accountant. The number one mistake people new to this make is just underestimating how much time it takes. They leave it to the last minute, they miss that 31st of January online deadline, and they walk right into that first penalty. The advice is so simple. Mark that date in your calendar and start getting your stuff together early. And by early, I don't mean Christmas.
So as we wrap up, it's pretty clear that frozen tax thresholds and rising wages are creating a whole new tax reality for millions of people. This stealth tax era is well and truly upon us, and it leaves us with a pretty direct question. Is your financial plan ready for it? Now, of course, we have to say that everything we've talked about today is for general guidance only. Tax is complicated and it's personal. Plus, the laws can and do change. So please, don't rely on this alone to make big financial decisions. If any of this has raised a few questions or concerns, the best thing you can do is take control. We really do encourage you to speak to a professional. For expert advice that's tailored to your exact situation, get in touch with the team at Pro Tax Accountant. You can call or WhatsApp them on 07985689912 or drop them an email at info@protaxaccountant.co.uk. And for more insights like this, don't forget to subscribe to the Pro Tax Accountant channel. Thanks for your time.